Top 25 Finance Job Interview Questions and Answers. Welcome back to the channel. If you're preparing for a finance job interview, whether it's in accounting, banking, financial analysis, corporate finance, or investment roles, this video is exactly what you need. Finance interviews are not just about numbers. They test your analytical thinking, business judgment, and communication skills. In today's video, I'll walk you through the top 25 most commonly asked finance interview questions, along with clear, practical, and well-structured answers that interviewers actually want to hear. Let's get started. 1. Tell me about yourself. This is usually the opening question, and interviewers want a concise professional summary, not your life story. Start with your education, then mention relevant experience, key skills, and current career goals. Focus on finance-related strengths, such as analysis, reporting, budgeting, or forecasting. End by explaining why you're excited about this role. A strong answer shows confidence, clarity, and relevance. Remember, this question sets the tone for the entire interview, so keep it structured, professional, and aligned with the finance position you're applying for. 2. Why do you want to work in finance? Interviewers ask us to understand your motivation and long-term interest in the field. A strong answer highlights your passion for problem-solving, numbers, and decision-making. You can mention how finance impacts business strategy, investment decisions, or economic growth. Personal experiences such as internships, coursework, or real-world exposure add credibility. Avoid generic answers like, "I like money." Instead, show that you understand the responsibilities and challenges of finance roles and are genuinely interested in creating value through financial insight. 3. What financial statements are you familiar with? This question tests your basic finance knowledge. You should confidently explain the 3 main financial statements: the income statement, balance sheet, and cash flow statement. Briefly describe what each statement shows and how they are connected. Mention that the income statement shows profitability, the balance sheet reflects financial position, and the cash flow statement tracks liquidity. Interviewers appreciate candidates who understand not just definitions, but how these statements are used together for financial analysis and decision-making. 4. How do you analyze a company's financial health? A good answer explains both qualitative and quantitative analysis. Start with reviewing financial statements, profitability ratios, liquidity ratios, and leverage ratios. Then mention cash flow analysis, trends over time, and comparisons with industry benchmarks. Also highlight non-financial factors, such as management quality, market position, and economic conditions. This shows you understand that financial health isn't just about numbers, but also about sustainability and risk. Interviewers want to see a structured, analytical approach rather than random metrics. 5. What is working capital and why is it important? Working capital is the difference between current assets and current liabilities. It measures a company's short-term liquidity and ability to meet operational expenses. Positive working capital indicates financial stability, while negative working capital may signal cash flow issues. Explain that efficient working capital management ensures smooth operations, timely payments, and reduced reliance on external financing. Employers value candidates who understand how managing receivables, payables, and inventory directly impacts cash flow and business performance. 6. Can you explain the concept of cash flow? Cash flow refers to the movement of money in and out of a business. Explain the 3 types: operating, investing, and financing cash flow. Operating cash flow shows cash generated from core business activities. Investing cash flow reflects asset purchases or sales, and financing cash flow involves debt and equity transactions. Emphasize that strong cash flow is crucial for sustainability, even if a company is profitable on paper. Interviewers want candidates who understand liquidity, not just accounting profits. 7. What is the difference between accounting profit and cash profit? Accounting profit is calculated using accrual accounting principles and includes non-cash expenses such as depreciation and amortization. It reflects profitability on paper, based on revenues earned and expenses incurred during a period. Cash profit, on the other hand, focuses only on actual cash inflows and outflows. A company can show strong accounting profits but still struggle with cash flow due to delayed receivables or heavy investments. Interviewers ask this to assess your understanding of liquidity versus profitability, which is critical in financial decision-making. 8. What are financial ratios and why are they important? Financial ratios are numerical tools used to evaluate a company's performance, stability, and efficiency. They help analysts compare companies, track performance over time, and identify strengths or weaknesses. Common categories include liquidity ratios, profitability ratios, leverage ratios, and efficiency ratios. Ratios simplify complex financial data into meaningful insights that support strategic decisions. Interviewers want to see that you not only know formulas, but also understand how ratios are applied in real business scenarios to assess risk and performance. 9. Can you explain the time value of money? The time value of money means that a sum of money today is worth more than the same amount in the future due to its earning potential. Money available now can be invested to generate returns over time. This concept is fundamental in finance and is used in valuation, investment decisions, and capital budgeting. Interviewers expect you to understand discounting, compounding, and how interest rates affect future and present values. It demonstrates your ability to evaluate long-term financial decisions accurately. 10. What is budgeting and why is it important in finance? Budgeting is the process of planning and allocating financial resources for a specific period. It helps organizations control costs, forecast revenues, and align spending with strategic goals. A well-prepared budget improves financial discipline and decision-making. Interviewers ask this to assess your understanding of financial planning and cost control. In finance roles, budgeting ensures efficient resource utilization, highlights potential risks, and helps management track performance against financial targets. 11. What is forecasting and how is it different from budgeting? Forecasting is the process of predicting future financial performance based on historical data, market trends, and assumptions. It is flexible and updated regularly as new information becomes available. Budgeting, on the other hand, is a fixed financial plan created for a specific period, usually a year. While budgeting sets financial targets and spending limits, forecasting helps management adjust expectations and strategies in real time. Interviewers want to see that you understand how both tools work together to support effective financial planning and decision-making. 12. What is depreciation and why is it important? Depreciation is the systematic allocation of an asset's cost over its useful life. It reflects the wear and tear or decline in value of long-term assets like machinery or equipment. Depreciation helps match expenses with revenues, ensuring accurate profit measurement. It also reduces taxable income and plays a role in asset valuation and capital budgeting. Interviewers ask this to test your understanding of accounting principles and how non-cash expenses impact financial statements. 13. What is EBITDA and why do companies use it? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It measures a company's operating performance by focusing on earnings from core operations. Companies use EBITDA to compare profitability across businesses with different capital structures and tax environments. It removes non-operating and non-cash factors, making comparisons easier. Interviewers want to know if you understand both the usefulness and limitations of EBITDA, especially that it does not represent actual cash flow. 14. How do interest rates affect financial markets? Interest rates influence borrowing costs, consumer spending, investment decisions, and overall economic activity. When interest rates rise, borrowing becomes more expensive, which can slow down business expansion and reduce stock prices. When rates fall, borrowing and spending typically increase, boosting economic growth. Interest rates also affect bond prices, currency values, and inflation. Interviewers ask this to assess your understanding of macroeconomic factors and their impact on financial decision-making. 15. What is risk management in finance? Risk management involves identifying, assessing, and minimizing financial risks that could negatively impact an organization. These risks include market risk, credit risk, liquidity risk, and operational risk. Finance professionals use tools like diversification, hedging, insurance, and internal controls to manage risk. Interviewers want to see that you understand how proactive risk management protects assets, stabilizes earnings, and supports long-term business sustainability. 16. Can you explain what capital budgeting is? Capital budgeting is the process of evaluating and selecting long-term investment projects that require significant capital. It helps determine which projects will generate the best returns over time. Common methods include net present value, NPV, internal rate of return, IRR, and payback period. Interviewers ask this to test your ability to assess investment opportunities and make financially sound decisions that align with business objectives. 17. What is net present value, NPV? Net present value, or NPV, is a capital budgeting method used to evaluate the profitability of an investment. It calculates the difference between the present value of future cash inflows and the initial investment cost. A positive NPV means a project is expected to generate more value than it costs, while a negative NPV suggests it should be rejected. Interviewers favor candidates who understand that NPV considers the time value of money and risk, making it one of the most reliable tools for investment decision-making. 18. What is the internal rate of return, IRR? The internal rate of return is the discount rate at which the NPV of a project becomes zero. It represents the expected rate of return on an investment. If the IRR is higher than the company's required rate of return or cost of capital, the project is considered acceptable. Interviewers ask this to see if you understand investment appraisal techniques. A strong answer also mentions limitations, such as multiple IRRs or misleading results when comparing mutually exclusive projects. 19. What is the payback period? The payback period measures how long it takes for an investment to recover its initial cost through cash inflows. It is simple and easy to calculate, making it useful for quick assessments. However, it does not consider the time value of money or cash flows after the payback point. Interviewers want to know that you understand both its usefulness and limitations. It is often used alongside more advanced methods like NPV and IRR. 20. What is the cost of capital? The cost of capital is the minimum return a company must earn on its investments to satisfy its investors and creditors. It represents the opportunity cost of using funds for a particular project instead of alternative investments. Companies usually calculate it as the weighted average cost of capital, or WACC, which combines the cost of equity and the after-tax cost of debt. Interviewers ask this to evaluate your understanding of investment decision-making and how companies assess whether a project adds value. 21. What is WACC and why is it important? WACC, or weighted average cost of capital, is the average rate of return a company is expected to pay to all its investors, including shareholders and lenders. It weights each source of capital based on its proportion in the company's capital structure. WACC is important because it is used as the discount rate in valuation and capital budgeting. Interviewers look for candidates who understand that WACC helps determine whether investments generate returns above the company's financing costs. 22. What is financial leverage? Financial leverage refers to the use of borrowed funds to increase potential returns on investment. By using debt, a company can amplify profits when business performance is strong. However, leverage also increases risk, as interest payments must be made regardless of profitability. Interviewers ask this to assess your understanding of risk-return trade-offs. A strong answer explains both the benefits and risks of leverage and how excessive debt can negatively impact financial stability. 23. How do you handle financial data accuracy and integrity? Ensuring financial data accuracy involves following standardized procedures, double-checking calculations, and reconciling accounts regularly. I rely on strong internal controls, proper documentation, and data validation checks to minimize errors. Confidentiality and ethical standards are also essential. Interviewers want to see that you take responsibility for data integrity because financial decisions depend on accurate information. This question tests your attention to detail, professionalism, and commitment to ethical finance practices. 24. How you stay updated with financial trends and regulations. I stay updated by following financial news, industry reports, and regulatory updates from reliable sources. I also take online courses, attend webinars, and read professional publications. Staying informed helps me adapt to changing market conditions and compliance requirements. Interviewers ask this to evaluate your commitment to continuous learning. In finance, staying current ensures better decision-making, risk management, and long-term career growth. 25. Why should we hire you for this finance role? This is your opportunity to summarize your value. A strong answer highlights your technical skills, analytical thinking, and ability to contribute to business goals. Mention relevant experience, attention to detail, and problem-solving abilities. Also emphasize your eagerness to learn and adapt. Interviewers want confidence without arrogance. Show that you understand a role and are genuinely motivated to add value to the organization. Thank you for watching. If you found this breakdown of the top 25 finance job interview questions and answers helpful, don't forget to like, share, and subscribe for more career-focused content. Preparing strong answers is the key to confidence and success in finance interviews. Best of luck with your interview. Go in prepared, stay calm, and let your skills speak for themselves. See you in the next video.